So, when China suddenly and surprisingly reopened in December, a lot of folks thought, hey, this is great, right? This is exactly what we need right now as growth is slowing. But, we're about, 4 months into this reopening, or since they've done that. And it looks like things are starting to run out of steam. How much of a concern is that for Asian economies and markets?
Yeah, we don't think that things are running out of steam, so to speak. I think that there was an issue between expectations of what reopening would look like and then what we've seen with regards to reality in the data. And I think a lot of economists and strategists looked at the example of U.S. or Europe or places where you had a large amount of fiscal stimulus, you had cash transfers to households, and then as reopened, you saw just an extra surge of consumption, a very sharp V-shaped rebound. China, there really was not that household stimulus. You didn't see any extra monetary or fiscal stimulus in the economy. So it's more of a natural recovery where you have excess savings, pent-up demand. So it's more or less in line with our expectations. We think it will be gradual. We don't think it's running out of steam, though. We think it'll be gradual, but in fact, it could be slightly even longer than I think what the market expects. But it's ongoing. Data is continuing to come in positive, particularly on consumption, particularly on services. But I think, yes, it has somewhat surprised expectations, which were likely too high.
Alex, so should we stay invested? And if so, what should we own if we're heading into a period of uncertainty?
On the first question, yes, absolutely. On the second question, we have been favoring fixed income, given what we've seen from a very high level of yields. We're looking at both short duration credit or even long duration, particularly adding core fixed income with regards to treasuries or other safe haven assets, because we think yields will come down. We think those will offer downside protection. We do think, given that the level of yields that we're seeing, particularly in credit, that it's an attractive entry point. It's attractive to lock in yields. We think from an equities perspective, while I said a cyclical downturn globally historically has not been a good thing for Asia, it is the most desynchronized cycle that we really have ever seen, largely because of the artificial aspects of COVID zero, and reopening. So you are seeing a China acceleration, or China continuing to grow at a healthy rate, even if in the event the rest of the world does slow down. So we do favor China as well from an equities perspective.
Why European equities, Alex, when you have President Macron struggling with political unrest and getting pension reform through, and arguably we have not seen the end of the banking stress there as well as in the United States?
Yeah, there's certainly quite a bit of uncertainty, whether it's with domestic politics in France or uncertainty around what we're seeing with regards to deposit outflows. We do think that with regards to the European banking sector, that Credit Suisse was a one-off event. It did look quite unique in terms of its lack of profitability compared to other banks. So we do think other banks were quite healthy and actually looked like an interesting opportunity. But it largely stems around the fact that Europe is still trading at a pretty healthy discount to the U.S., and we think that discount gap will close. In addition, from a growth perspective, we do think that Europe is likely to avoid a recession, and growth there looks okay.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.